Over the past couple of years, the real estate investment trust sector has been going through a bit of a roller coaster ride. If we take a closer look at the Vanguard Real Estate Index Fund ETF, it becomes evident that after REITs initially recovered from the early pandemic dip, they started to encounter some turbulence around late 2021. As an investor with a substantial portion of my portfolio invested in REITs, I've been keeping a watchful eye on these developments. It's essential to recognize that the REIT sector is currently grappling with a couple of significant challenges. In today's video, I want to delve into these challenges, offering my insights on when we might anticipate a robust recovery within the sector. Additionally, I'd like to highlight a few REITs that are currently trading at substantial discounts, presenting appealing yields and promising growth potential. One of the prevailing issues affecting REITs right now is the historically high federal funds rate, currently sitting at a 22-year high. Elevated interest rates have several detrimental consequences for REITs. When interest rates rise, companies often tend to scale back their spending and slow down their expansion plans. This presents a unique predicament for REITs, given that they are legally mandated to distribute 90% of their earnings as dividends to shareholders, thereby enjoying considerable tax benefits. However, this leaves them with limited resources to reinvest in growing their businesses. Consequently, REITs frequently resort to borrowing to finance new acquisitions or property developments. Yet, borrowing at high interest rates leads to increased interest expenses, ultimately diminishing their income. Another pertinent challenge arises when REITs hold floating rate debt, which becomes progressively more costly as interest rates ascend. While the majority of REITs favor fixed rate debt, some do carry floating rate debt, which can lead to heightened expenses in a high interest rate environment. These issues have indeed impacted the entire REIT sector, but one subset has borne the brunt of the storm: the office REITs. The S&P 500 Office REIT Sub-Industry Index has experienced a precipitous drop of nearly 50% since early 2022, primarily due to soaring vacancy rates in office properties. The trend is particularly pronounced in markets such as San Francisco and Chicago. Numerous office REITs have witnessed declining occupancy rates, making it challenging to maintain dividend payments. Some have even been compelled to reduce their distributions. For instance, Office Properties Income Trust had to trim its dividends from 55 cents per share to 25 cents per share. Hudson Pacific Property is another office REIT that has endured a significant share price decline and a 50% dividend reduction in 2022. To address these challenges, some REITs have opted to divest properties to slash their debt burdens. However, this strategy also curtails the revenue available for distribution to shareholders. While the issues affecting the office REIT sector may persist, it's essential to recognize that not all REIT sectors are similarly affected. Various types of REITs, such as those focused on data storage centers, apartments, convenience stores, and self-storage properties, have managed to maintain robust occupancy rates. The crucial question on everyone's mind is when REITs will embark on their journey to recovery in terms of share prices. The timing of this resurgence largely hinges on the Federal Reserve's monetary policy regarding interest rates. The market tends to react swiftly to Federal Reserve Chair Jerome Powell's pronouncements on interest rates. If Powell underscores a decline in inflation, the market typically responds with optimism. Conversely, if he suggests that inflation will remain elevated, necessitating further interest rate hikes, stocks tend to retreat. Therefore, the timing of the recovery is inextricably linked to when interest rates commence their descent. Inflation constitutes a pivotal factor in this equation. Although inflation recently receded to a two-year low of 3%, the Federal Reserve targets a 2% inflation rate. Powell has indicated that all options are on the table, including potential rate hikes, but they aim to commence rate reductions next year. Once the environment becomes conducive to REITs, analysts are predicting a resurgence within the sector. In spite of the share price declines observed across the REIT sector, a multitude of high-quality REITs currently trade at significant discounts, offering attractive yields. For example, Crown Castle specializes in operating and leasing cell towers and fiber infrastructure, currently yielding over 6%. WP Carey focuses on owning operationally critical real estate and offers a dividend yield of over 6.5%. Starwood Property Trust, the largest commercial mortgage REIT in the U.S., boasts a yield of over 9%. Once interest rates commence their decline, these REITs could very well experience substantial recoveries. In conclusion, while the REIT sector, with the exception of office REITs, is facing its share of challenges, it simultaneously presents compelling opportunities to invest in high-quality, discounted REITs. The timing of the recovery hinges largely on when interest rates begin their descent. Despite the current uncertainties, numerous REITs remain steadfast, especially the dividend aristocrats like TripleNet, Federal Realty Trust, and Realty Income. Thus, while the road ahead may seem uncertain, I firmly believe that the majority of REITs continue to exhibit resilience and promise. So, stay tuned for more updates on this exciting space. And don't forget to like and subscribe if you wish to explore further high-yield investment strategies. Your financial journey is our shared adventure.